One of the gnarliest things about this is the required rate of return. So I'm going to spend a few minutes talking about required rate of return. You can't get a required rate of return using this information. This is CAPM type stuff. This is stuff that's backwards looking. This is one of the most interesting ways to lie with statistics that you can come up with, because this was that chart from 26 to the current time showing that small stocks usually make more than big stocks, which make more than bonds, and which make more than inflation. And so we've bought in to this idea that this historical analysis gives us something that we can hang our hat on. In the Pratt and Grabowski Cost of Capital book, which you're all going to purchase after this session here and have Dr. Pratt sign it for you, this is one of the best little graphs in there. It's exhibit 15.14, and it shows the time frames in which large stocks won and small stocks won. This is just one example of why the backwards looking data mining process does not work. So this is for all the various holding periods since 1926. So on the left-hand side, you have the longest holding period. On the right-hand side, you have the shortest holding period. Well, this line right here shows you what you would have, who won, large stocks or small stocks, in a that line right there is expressed as a constant 5-year holding period. So if every single year you invested in small stocks and you kept it for 5 years, that line tells you what your, who won and who lost. I think this line basically says probably 30% of the time, maybe a third of the time, large stocks won. Well, and look at this place right here. 1983 to 2013, if you had invested in small stocks in 1983, you would have lost compared to large stocks through that period of time, 30 years. That's a long time to be in the wilderness. The point here is, and people that want to have a high valuation will go and say, oh, there's no small stock premium. Look at this. They didn't win for 30 years. And there were articles written about this. And of course, the whole point of what I'm saying is, just because they didn't win doesn't mean they're not more risky. They need a higher rate of return. The question is, how do you get that higher rate of return? You can't get it from the backwards-looking data. You can only get it from forward-looking data. So I went and I talked with some people who make these kinds of investments, secondary market venture capitalists, secondary market private equity. What kinds of rates of return are they looking for ex ante, which means before the fact? They are looking for rates of return in the 40 to 50% range. All right? And these are companies that they're investing in, which are just like very much like the companies that we have, except that they're intending to sell them at some point. There is a liquidity event out there in the future, and so there is a definite time frame that they will get some liquidity. Those are pretty high rates of return. Dr. Paglio also showed you some of this earlier today. This is totally forward-looking material. The Pepperdine study is about 10% of what we need. There's just a lot of ways that this needs to be improved, but I've talked with John about, why don't you go and ask investors in the public markets what your required rates of return are, in the public markets. I think that would be really instructive. Bruce Johnson also put this out. This doesn't give you the complete required rate of return, but it does give you a cap rate. And what you see here, basically this data says people are looking for, at that time, about a 10% cap rate, and they were also looking for 20 to 25% rate of return total on the investment before these limited partnerships dissolved. So the question is, all right, so given all this information, what kind of rate of return do we need to have on Uncle Joe's family limited partnership? Of course, I'm lying with this chart here because I organized it in such a way that it looked like it was going to be bigger at the bottom because all the numbers gets bigger and bigger as you go down. I don't necessarily think that's true. But that's the question. This is kind of the data that we need to start thinking about. So in conclusion, the discount for lack of control, lack of marketability, and liquidity don't work. No investor uses that methodology to get to the value that the price they're going to pay for something. And I just want to let everybody know that I'm just standing on the shoulders of a bunch of other people. This is not new with me. If you go to the SEC, they won't even consider this kind of stuff. Delaware Chancery, state courts, there have been some appellate cases. I don't know if Richmond is going to get appealed, but if it did get appealed, there might be a complete reversal of that decision. But the ones that were reversed, and I'm going on the information from other people, I haven't read these in a while, is Church, Jelke, and Dunn, and there's been some others too. So this is something which has been bubbling up for a long time. There's a lot of people who understand this. What I would just basically say is try it. Give it a shot. Eventually, you may get to the point where the income approach becomes your primary method and the discount analysis becomes kind of a sanity check. We need more and better science, better survey data. We need to get into the heads of the investors and replicate their thought processes. I think that's it. Thank you.